Welcome to Fresh Thinking School of Wealth Building. How to create wealth through property investment. The year was 1992. I was 28 years old. I had just returned from Oxford University with a PhD. Another white colleague at Cambridge University offered me to rent her family room. I was so excited until my first mentor asked me, why should I not buy my own property? That moment changed my life forever. Within 24 hours, I bought the flat for 40,000 rand. Over the years, that property has generated 1.5 million in rental revenues over the years. The property is now valued at 750,000 rand and generates a monthly rental income of 7,500 per month. Property investment has long been a cornerstone of wealth creation, offering a tangible path towards financial security and long-term prosperity. Property represents a physical asset with inherent value, unlike stocks or bonds that exist as abstract entries on a screen. This tangible nature provides a sense of security and control for investors. However, the appeal of property investment runs deeper than simple owning a piece of land or a building. It is about leveraging the unique characteristics of real estate to generate wealth through various avenues. Property offers a diverse range of wealth building strategies, whether it is the steady income stream from rental properties, the potential for capital appreciation as property values rise, or the ability to leverage financing to control a larger asset. Of course, property investments is not without its challenges. It requires careful research, strategic planning, and often a significant financial commitment. Market fluctuations, property management responsibilities, and potential legal complexities can all pose hurdles along the way. However, with a well-informed approach and a long-term perspective, property investment can be a powerful engine for building lasting wealth and achieving your financial goals. Here's how to get started. The first way to create wealth is through property investment. Before venturing into property investment, it is essential to grasp the forces that shape the real estate market. Familiarize yourself with the dynamics of property values, understanding how they can fluctuate over time due to various factors. These include microeconomic conditions like interest rates and economic growth, as well as micro level influences such as the location's desirability, local amenities, and even crime rates. Analyzing rental yields is equally crucial. This involves understanding a property's potential income relative to its purchase price and ongoing expenses. Factor in potential vacancy periods and the costs associated with property management. Financing plays a pivotal role in property investment. Explore different mortgage options, comparing interest rates, loan, loan terms, and the impact of leverage on your potential returns. Leverage using borrowed capital to purchase an asset can amplify gains but also magnify losses. So understand its implication It's vital. Decisively, don't overlook the legal and tax implications. Familiarize yourself with property laws, including tenancy, zoning, and property development regulations. Understand the tax implications, such as capital gains tax on property sales and annual property taxes. Research potential deductions for expenses like mortgage interest and property maintenance, as these can significantly impact your overall returns. By thoroughly understanding these aspects, you can confidently make informed decisions and navigate the complexities of property investment. The second way to create wealth is by developing a strategy. Clarify a clarity of purpose is paramount in property investment. Begin by defining your investment goals. Are you seeking long-term growth through property appreciation? Do you prioritize generating consistent rental income? Or perhaps you aim to flip properties for quick profits? Articulating your objectives will guide your investment strategy and help you identify suitable properties. Assess your risk tolerance. Different property types and locations carry varying levels of risks. Are you comfortable with the higher risk associated with up and coming neighborhoods that offer the potential for high growth? Or do you prefer the stability of established areas? When evaluating risk, consider your investment timeline and financial capacity. Speaking of financial capacity, honestly assess your budget. Factor in the down payment, closing costs, legal fees, and ongoing expenses like property taxes, insurance, and potential maintenance. Don't overextend yourself financially. Ensure you have a comfortable buffer to handle unexpected costs or potential vacancy periods. A realistic budget will protect you from financial strain and allow you to make sound investment decisions. The third way to create wealth is by identifying promising properties. The age-old adage in real estate, location, 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 holds for a reason. The location of your property significantly impacts its value, rental potential, and appreciation prospects. When evaluating potential investments, prioritize areas with solid growth potential as indicated by population growth, economic development, and infrastructure improvements. Consider the quality of local schools, proximity to amenities like parks and shopping centers, and the overall safety of the neighborhood, as these factors attract tenants and drive demand. Choosing the right property type is equally important. Align your choice with your investment strategy and risk tolerance. Single family homes cater to families and offer stability, while apartments provide diversification and the potential for higher rental yields. Commercial properties like retail spaces or offices come with different lease structures and management considerations. Before committing to any property, conduct thorough due diligence. This involves more than just a a cursory viewing. Engage qualified professionals to conduct inspections, assess the property's condition, and identify potential issues requiring costly repairs. If you are considering a rental property, review its rental history, including tenant turnover rates and previous rental income to gauge its income generating potential. By carefully evaluating location and property type and conducting comprehensive due diligence, you can minimize risks and maximize the chances of a successful investment. The fourth way to create wealth is to secure financing. Before investing in property, it is crucial to secure financing. Start with the mortgage pre-approval. This involves providing a lender with your financial information so they can assess your borrowing capacity. Pre-approval gives you a clear picture of what you can afford and strengthens your position as a buyer. Sellers are more likely to consider offers from pre-approved buyers as it demonstrates your financial readiness. Don't settle for the first mortgage offer you receive. Take the time to compare loan options from different lenders, interest rates, loan terms, and closing costs can vary significantly. Explore various loan types, such as fixed rate or adjustable rate mortgages, to determine which best suits your financial situation and risk tolerance. Remember, lenders are willing to negotiate. Don't hesitate to negotiate interest rates and closing costs to secure the most favorable terms. Even a slight reduction in interest rates can save you thousands of rands over the lifetime of the loan. By taking a proactive and informed financing approach, you can significantly reduce the overall cost of your property investment and improve your long-term returns. The fifth way to create wealth is to manage your investments. Effectively managing a rental property is crucial for maximizing your returns and minimizing stress. Tenant screening is your first line of defense. Thoroughly vetting potential tenants helps ensure you select reliable individuals who will pay rent on time, respect the property, and minimize potential issues. Background checks, credit reports, and contacting previous landlords can provide valuable insights into a tenant's reliability. Property maintenance is another crucial aspect of successful property investment. Regular upkeep, timely repairs, and proactive renovations attract and retain good tenants and preserve the property's value over time. A well maintained property commands higher rents and appreciation, contributing to your long-term wealth building. Sound financial management is essential. Meticulously track rental income and expenses, including mortgage payments, property taxes, insurance, and maintenance costs. Familiarize yourself with tax laws and leverage deductions to optimize your returns. Reinvest profits wisely, whether into property upgrades, faster mortgage payment, or diversification into other investment opportunities. By diligently attending to these aspects of property management, you can transform your investment into a reliable source of passive income and a valuable asset for the future. The sixth way to create wealth is through key considerations. Property investment is a marathon, not a sprint. It requires a long-term perspective and the understanding that significant returns typically materialize over several years, even decades. This means resisting the urge to chase quick profits or react impulsively to short-term market fluctuations. Instead, focus on the bigger picture, building equity, generating consistent rental income, and leveraging the power of compounding over time. The property market, like any other, is cyclical. Values can fluctuate, influenced by factors such as interest rates, economic conditions, and local development. Be prepared for these market cycles and the potential for short-term losses. This means having a financial cushion to weather down turns and avoiding over leveraging yourself with excessive debt. A long-term perspective lets you overcome these fluctuations and capitalize on the inevitable upswings. Embrace the fact that property investment is a journey, not a destination. There will be challenges and uncertainties along the way, but by maintaining a long-term vision, staying informed about market trends, and making sound financial decisions, you can navigate these complexities and ultimately achieve your wealth building goals. The seventh way to create wealth is through active management. Property investment, while potentially lucrative, is not a passive endeavor. It demands active involvement and a commitment to ongoing effort. Property ownership comes with a unique set of responsibilities, unlike buying stocks and bonds. Be prepared to handle tenant issues, from late rent payments to maintenance requests. Regular property upkeep, including repairs and renovations, it's essential to preserve its value and attract quality tenants. Furthermore, administrative tasks like managing finances, paying property taxes, and ensuring compliance with local regulations require time and attention. Successful fully navigating these responsibilities require a proactive approach and a willingness to adapt to changing circumstances. However, the rewards can be significant. By combining careful planning, thorough market knowledge, and diligent management, you can leverage property investment to build substantial wealth over time. The ability to generate rental income, the benefit from property value appreciation, and utilize leverage to control a more significant asset makes property a powerful vehicle for achieving financial goals. While the journey may require effort and dedication, the potential for long-term financial security and prosperity makes it a worthwhile pursuit. This is Dr. Masasekane Mishakosa, Director, Fresh Thinking School of Wealth Building Through Property. Thank you very much. We really appreciate you coming to our channel. Really appreciate that. Thank you.